Welcome, lesson of the day. You can either get played by the algos or you can try to play the algos. Now, what I'm going to talk about here is not necessarily the easiest thing to do, but if you can put it into your toolbox and sometimes anticipate that there's going to be gamesmanship, then you can possibly make more efficient trades, get bigger gains, and do not get those shakeouts that frustrate us so much when we have the correct price area and even the correct price direction, but then we're just not able to hold on to the trade because you get shaken out. And the first things first, so like what I'm going to describe is usually centered around a price area, an area of interest on a stock that almost everybody is going to see. So you're talking about a key support level, a key resistance level, an obvious round number, stock gets to $100, and NVIDIA 1,000. Like these are the types of things where you can kind of anticipate sometimes there's going to be a lot of gamesmanship. And most of that's going to be done by institutional orders, by algos. When everybody knows where stops are likely to be, you can either roll with that punch and just take your trade how you always would. Sometimes it works, sometimes it doesn't. Or maybe you can anticipate an altered move around that price area, which will not be subject to the same kind of shakeout, but then give you that upside. So I want to talk about some ideas with regards to that. I'm going to start with one of the ones at the open that we discussed this on the morning show pretty much, I feel like all the time, and the amount of times that you're going to be able to see this setup, it's just multiple times a day with a stock in play. And that's why I want to start here first. And the example I'm going to use is Reddit because I think it's a fun one. And you saw after Reddit came to market, I mean, look, it had a pretty decent debut. Let's go, I can go daily chart first, I suppose. Like it had a pretty decent debut. But after it pulled back in, it should be obvious what I'm going to talk about here. It started selling off and then made it back to $44, which was that low on the daily you saw. That $44 level was already the bottom, and it put it in on April 1st. Wasn't a joke. It made a fresh IPO low. And at that point, you're looking at a double bottom on the daily. Now, an IPO doesn't have a lot of historical price action. So almost everybody is going to be saying, oh, that's a double bottom at the post-IPO low of 44. That's got to be a support level worth trading off. You have people wanting to go short if it breaks. You have people wanting to go long if it's going to do a hold. So how do you manage to be in this trade when it obviously does break the previous day's support level, it does wick the bottom, and then eventually run? So what's a way to not get stopped out there? There's a couple ways you could do it. One way to do it would just be to just give it an extra $1. Okay, well now you're just going to go long on the way down and say instead of getting out on a break of the previous low, 44.5, or a break of the even, you're just going to give it to 43. Fair enough. I think that's perfectly reasonable. But that is not necessarily the most efficient risk-reward way to do it. Because if you do that on a stock like Reddit, there's going to be a lot of slippage in your trade, and you might not be risking the extra $1. You could be risking an extra $1.50, maybe even $2. And that might not fit your risk to reward. If you want to try to still have your same style of trade where you have a tighter stop, you've got to almost anticipate that they're going to get run. And what that looks like is you just sit this move out here. At the open, when it makes the run at the bottom, you're anticipating could happen. If it continues and flushes through the low, you don't have to trade it. Great. You're not holding the long against you. You're not anticipating where you're going to get in. But if it does a snapback, and this is a 3-minute, if it snaps back and holds, now you've got two setups you can play. The aggressive setup, you can very plainly see the 44.5 support. There's your wick underneath. It holds 44. The aggressive play is just go long here with a stop there. That's one way to do it. But if you're even more conservative than that, you're anticipating the whipsaw action, anticipate it both ways. It then goes right up to, if it's going to be a bearish day, right to the previous close and gets a bit of a rejection. Now that's a spot where anybody thinking short Reddit, because it's been going down, is looking for short opportunities. So that's where bears are like, I'm just shorting into that upward move at the open. And then it pulls back in. It's a popular play. You've seen us do that short and work all the time on our live show. But what I think is your best and most conservative setup is the second it holds this higher low, and that's right in here at that 45, the next even dollar, you see the consolidation, One bottom, holds bottom, breaks this candle to the upside. It's about 45.15. You have reasonable stops. You can stop it here for 35 cents. You can stop it there for about 65 cents. And that way, you've got some people that were shorting. You've got some people that were long and got stopped out. You have maybe even some trap shorts down there. And you've got a very high risk to reward entry. What this requires you to do, however, is see that stock in the price area and be willing to sit out a lot of action at the open for that perfect setup. I mean, algo's running stops at the bottom, algo's running stops at the pre-market high, then getting a pullback, and then still looking for your entry. Requires a lot of patience, but because you're getting a tighter stop entry with some extra confidence, it allows you to then have more shares with that tight stop, and then have the potential upside for what you got over there in Reddit. So I think it's not always the easiest trade, but it's a very valuable one to have in your toolbox when you really, really like a price level and you want to get the shares in and you don't want to get wicked out. You want to get that good solid entry, but you also want to do it with a lot of confidence in maybe your bigger position. So the other thing I want to talk about here is just the obvious, and we've seen, I mean, how many times do we see this? Where you have a price area, but you don't necessarily have, the exact entry point off a key price level. And I think this is a difficult one for people to comprehend because, and actually let me go to a 15-minute on Tesla to better explain this. Like, you can see a stock when it's in a downward trend and it breaks to the downside. You would have heard me on the live show, and I talked about this yesterday even. You're keying in on a 168, which is a very important price for the stock previously when it was trading in this area, and you're looking for sellers out in front of it. So what ends up happening a lot of times is if you have a really good resistance spot or even a really good support level, you can have failure to get to that price. And what that simply means is, it's like if it gets there on that rubber band action, it's like it's too strong. If it gets to that 68 level, then the bounce off the top, bounce from the bottom might actually be too strong. It almost needs to stall out. Like, the sellers are getting in front of it, and you have to be willing to take the trades in front of it. And the best way to do that is to play the wicks. And what I mean by that is you're not going to get to your stop order at that 68, but you can say, okay, well, if it's showing me resistance at 166.5 in here, and I can zoom it over here, 166.5, it's showing me that resistance, don't take that fill. If I know 68's a top and it shows me 68.5 once, then let it break 68.5, looking for the fill here, where you're giving it the extra 50 cents, knowing you've got 68 behind you, and then that way, you've got two things working for you. If you're holding the 68 anyways, you're risking $1 instead of $1.50. That's one thing working for you. The second thing working for you is you've got people shorting here that are just going to stop out early. And when they stop out, you're actually getting in. So that wick top, you're getting an entry with some relief pressure as well. But just like the example before, what is the risk of that trade? You are sitting out the short if it doesn't actually break that local high the second time. If it doesn't break and form that wick, well, then you're not really getting that entry. But there are times where it's that far away from your anticipated resistance where you want to try to give it a little bit of extra room. And if you can do that and find ways to do it, you can be in a trade, say, against the short-term momentum with a little bit more confidence because you're entering after the algos have already stopped a bunch of people out. Like, you're finding an entry past a bunch of other pain points. That's the key with the example that I showed you with Reddit, and that's the key with the example here, what happened on Tesla. You're getting in after people have been stopped out. And sometimes you want to look for those pain points and say, I'm not going to go in until other people have gotten out of the trade, because then there's less resistance when it starts to fall back into that downside. And the key with these trades are, the more you like the price level, the more convicted you are in that area for trade, in that direction, the more things you want in your toolbox around that price area, especially ones that would allow you not to get wicked out. And I can say this as a trader who I've shown them many times getting top wicked and bottom wicked. You know that when that happens to you, that you were right about the area of interest and you were dead right. However, you just needed to adjust your entrance or exit strategy based on that price area. So that's why today's lesson is important, because you have to have these in your toolboxes so you can trade the really big levels without always getting run over. Sometimes you'll make top wick and bottom wick, but you don't always have to make top wick and bottom wick if you're going into the trade anticipating the algos want to run you. Now, if you anticipate it, sometimes you won't get into the trade at all because you're being picky. But when it does work, you're going to absolutely hit some bangers. And you've got to have it in your toolbox. Play the algos. Don't let them play you. You've got to bring other ways to step up your game because they're not going anywhere. So you can adjust or die. That's the lesson of the day.